All right then. If you've been watching my channel, you'll know that I've sold something pretty mental. I talked about this in my other videos, talking about probably maybe better off having dividend ETFs versus some of the individual stocks that I had. Now, within that journey, we discovered that maybe some individual stocks were going to get beaten up by tariffs and other economic elements. And that became a thing, especially when they dropped 15% in a day. The decisions that I've made have made a massive difference on my portfolio in two very obvious ways. And today I want to showcase why I did it, what the results are, and why I think now it's more important to focus and stick on this path instead of worrying about, say, the tech world. Because I am a Bitcoin investor. Even though that is coming down right now, I am massively up in profit. I have taken some profit, and that is still my risk. But yeah, this is a big change. If you follow my pie on Trading 212, you'll know what I'm going to talk about. So without revealing too much, the rate of return, by the way, on this Trading 212 platform is awful. The worst thing ever. I just can't get my head around it. But I am still overall quite profitable. But this month has been a bit of an interesting one, certainly with the two stocks that really did nosedive. Some of them were absolutely fine. That's okay. And I understand that. But when, as I say, one drops 15%, it becomes a bit of an issue. And for a dividend portfolio and the goal to hit £1 million over the course of the next decade or so, the goal is not to have volatility. It's for stability, realistically. You want to have, for me, my personal opinion, an income machine. This is why I have Bitcoin for the risk side of it. And I want to have this as my stability nest, essentially. So I had to make some choices to reflect that. And on the screen, yes, it's a bit more stable. I will go through what I did and why I did it, because I think it's more important than ever before to understand the obvious in the room. Longevity, consistency, and obviously time. So let's get into it. The first one that I sold was Hilton Food Group. As much as I seen the fundamentals, I enjoyed the fundamentals, it just wasn't working out. It was a really interesting one because of the drops. And obviously, yes, you can see over the course of the month here, we have dropped 27%, 28%. Oof. 6 months, quite a lot. It's been awful. Absolutely awful. And the situation was around, obviously, income reports and all those kind of stuff. And when we talk about share prices and obviously earnings and all that kind of stuff, they were expected worse earnings due to certain metrics. And one of the metrics was found out in April due to fish and tariffs. That was one issue. The second one, they were expecting their growth forecast to be lower than expected. That obviously made people crap themselves. In terms of the news, it's very, very clear for Hilton here. You can see here, the 11th of November, difficulties ahead, lots and lots of changes throughout the board. Now, that's the thing, we can talk about the 11th of November, huge drop off, and it was pretty ugly. 25% on growth warning. Oof, ugly, really is quite ugly. And not to mention the salmon stops. So yeah, issues. Now another one, a solid company, essentially still under the hood, great fundamentals, but it just one of those situations again with the same situation. I want a rise in income. I want to have dividend stocks that are pretty stable. And this was another one that created issues due to tariffs. And again, we could talk about the 6th of November here. There was a massive guidance cut, in terms of medium-term growth outlook, totally revised. And a lot of that was due to tariffs as well, back in April as well, not to mention even November, because majority of their revenue comes from the United States, which is a huge problem. By the way, if you're interested, you don't have to be, TradingView here is what I'm using. It's a fantastic website. I've used it since 2018, mainly for technical analysis, but over the last few years, what they've done is they've added a lot more to it. The new stuff is new, portfolio stuff is new, a lot more fundamental information. It's a really good tool, so I probably will be using it a lot more in my videos. But Black Friday, they have a monster offer, and you can see overall, you can save a hell of a lot of money versus the monthly payments. Even if you're just on the essential plan, it's 13 months. It's honestly so worth it. It's brilliant. Now, I have sold National Grid. Why? It's fine, but their dividend yield was not growing as much as anything else, really. It was one of the lowest by far in my viewpoint. Now, that isn't a bad thing. It's just the way it is. But obviously, yes, the price is also at one of its highest points. So I thought I'd just get rid of it. And yeah, there's also, I know, in the UK, there's a little bit of a backlash in terms of regulated utility companies. A lot of them are like kind of sick of the monopoly. So that could also become an issue. So, like the United Utilities, for example, you got Thames Water, you've obviously got National Grid. There's a lot of like calls to change that. And as you can imagine, yeah, I don't want to be in that. But their growth target for the dividends was actually by far pretty low. And I didn't really like that. But yeah, over the last 6 months, it's not been too bad. Certainly since I've been holding it, it's been okay. So that's been pretty useful. But fundamental wise, yeah, you don't want to be a part of a smear campaign. So another one as well is Phoenix Group, which is crazy in a way because their dividend yield was actually really, really high. But as you can see, the price has been falling down. I bought obviously a lot, not that long ago. The price has been going up, so that's pretty good. But as I say, the dividend was absolutely fine with this, but it did have horrible price action throughout the course of time. It's a bit of a revival company, pretty good in that sense. But the big thing with this is it's one of those industries where the finance and the life and health side of it can be very cyclical at certain points. Because even though on paper it's a fantastic company, there can be elements of volatility, especially if the UK government are going to start changing things, which they probably can do very, very easily at any given point, especially if you're in the world of labour. And as I alluded to it, the dividend yield is absolutely monstrous. But the reality is here, as I say, there could be some pretty big changes that could spook the pension market. And you could argue with my portfolio, I already had one that covered pensions, so I didn't want to double dose on it. So yeah, I've kind of just reduced the risk on that side of it. But overall, it's not a bad stock. But yeah, it's just one of those situations where if you have too many of one thing, could be an issue. And the final one that I got rid of was Admiral. Why? Just because, as you can imagine, too many insurances. I had 3 at one point, realistically. When you talk about Phoenix, you could talk about Aviva, which I still have, and obviously Admiral. I use Admiral, really, really good company, but ultimately, as I say, too much in one thing could be an issue. And again, it was one of those ones where it had one of the weakest kind of growth cargos for dividends, so it was kind of an easy one. Same as National Grid, it was very, very low. But it isn't a bad company, realistically. It's pretty big, obviously, for the world of insurance and stuff like that. But as you can imagine, yeah, the dividend yield is all right. Good capitalization of the asset alone. It's been around for a while, but there was a couple of little things that I thought, well, actually, what's the point of having too many of these? And, I couldn't really justify it. However, the big, big boy decision, even though I've sold 5 stocks, I have also sold the All World Fund. Now, this, as I say, is a big one. It did very well for me in the short time period that I had it. And yeah, it was a classic set and forget, and I have talked about how this should be a really good one for a beginner. But we need to talk about why I've done this. The technology side of it's pretty heavy. And it is a fantastic fund, don't get me wrong. It does offer you more growth, obviously. But the reality is, let's talk about something that's quite obvious. And as you can see, the performance has been fantastic. But the reality with this is the dividend yield, obviously it's an accumulation fund. We're talking roughly 1%, give or take, in terms of dividends, because it is very, very tech heavy. As much as it will, as I say, give you better growth, there's issues where you could find a problem with volatility. And already, you can't see this on my screen, but on the tabs I can see it. The fund that I've replaced it with, and I've added a few by the way, this is down over 1% more than the dividend one, which is important to know, right? So when we talk about why this is important, the big factor around this is a lot of it is technology services and technology, a massive, massive weight. Nvidia is a huge part of this fund. Obviously, Microsoft, Apple, Broadcom, basically the Magnificent Seven is here. So the top 10 is a 24% weight. That is a big issue in my sense for, handling volatility. As much as it is good for growth, and if you are younger or if you want to get a bit of growth, this isn't a bad one to hold. But as I said, I've changed my goalposts a little bit for stability and for income. And that income part is hugely important. Because what I have bought is this. It's basically the same thing, but the all-world high dividend yield. And this is the thing. This is the crux of it. It replaces it for simplistic reasons. It still holds over 2,100 stocks. It's great. It's got a much higher yield. It's got global exposure. It's more stable. It's got huge diversification still. It's a lot more consistent in terms of its holdings, in terms of management, because it is focused on dividends, and it does have a lot lower volatility. That is hugely important. But as I say here, its performance has been fantastic over the course of time. It's been a really, really good one. But again, we can go back to the other one here. I mean, the volatility on this one is totally different. Chalk and cheese. And that's on the monthly time frame. Weekly time frame, you can still see the growth of it in terms of this is the All World Fund, by the way. And obviously, yes, you can go on to the other one. It's still performing pretty well. There's periods where it doesn't perform as well, but you're getting an income. That's fine. But over the course of time, you're going to thank it for the less down days, realistically, because as funds grow, your emotions will get a little bit more out of control. And the reality is, this still offers growth and it offers a much higher dividend yield. Now, the other one that I've also added, I've added 3. This one brings quality and growth. The TDGB. Now, one thing with this, I will have to say, there is withholding tax on it, so there's a little bit of an element there, but it is high quality companies that are actively growing their dividends year on year. And this is in developed markets, basically Europe and America. It's a really good one in my viewpoint. And obviously you can see the overall growth performance is really, really nice. The dividend yield is almost 4%. So obviously when we talk about the expense ratio and the withholding tax, yeah, there's a little bit of a haircut there, but you do get pretty consistent growth. I mean, the growth of it is ridiculous. Over the course of the last 5 years, it's been really, really solid. And that is a dividend-based ETF. Pretty awesome, really. So when you combine them both together, you've got decent growth, and more importantly, you have decent yield, which we will come on to because there's another one I want to mention. This is the high dividend yield ETF based off the UK. Strong UK dividend payers, simple as that. High yield, awesome. Lower volatility, yes. And the dividends that hit the account without any withholding tax, which is also an important factor. Now with this, yes, you can argue it's down over the course of time from its inception, but it came out at a little bit of a topsy-turvy time. So it has recovered certainly from those points. And, as I say, the dividend yield is roughly 5%, which is absolutely awesome. And that's the thing. We can talk about what's in here, and there's a lot of decent stuff in here. These are really solid top UK holdings that are pretty much the top part of Britain, which is fantastic. So for me, combining all 3 of them, it just makes more sense. But when we look at the overall portfolio on the screen, you can see the passive income on the right-hand side. This has went from 2-point-something% to 4.22%. Ridiculous, really. And that's all because I've reduced the amount of stocks that I've got and I've focused on income. I've focused on growth. And that has massively changed. And as I say, it is a huge jump just from reallocating, not changing anything massively or craziness. I've not added new money to get that. And that's just the thing. Even though the overall portfolio is down, it isn't as down as what it would be realistically. So yeah, we've jumped up quite a lot. I think we've gone from 1,700 to 2,553, which is mental. Yes, we could talk about the dividend calculator. We could talk about the 4.29% yield. We can talk about the potential payments that we're going to get a lot more over the course of the months as well, which is also a random crazy change that I wasn't expecting. We've reduced our stocks, but nearly every single month, apart from January, give or take, we're going to get paid. Whereas in my previous video, there's about 3 or 4 months that we're going to miss out on. And the best thing about all this is the ETFs are going to do the heavy lifting, which makes it so much easier. My overall portfolio just seems a lot more safe and less volatile, and that's what we want, realistically. So when we talk about the likes of what I have here, which for some people, lovely, 30% in one, 20%, 20%, awesome. Lower volatility, better diversification, more predictable dividend flows. It's probably easier to hit that 1 million dividend goal through income, through consistent investing. And hopefully it's smoothed out the risk of only having so many stocks now, which is Aviva, Coca-Cola HBC, Drax, Mighty Group, Smiths News, and Tesco's. And also looking ahead to the obvious, what income will this give me? A higher dividend yield, a much better growth rate. I could be seeing, and I know this is all could be blown off course at any point, I could be seeing in literally 10 years time from this point, if I keep adding £20,000 every single year, 23,000, I could be doubling pretty much the income or the allocations I can put into this portfolio just through the world of compounding. And hopefully that is the case. And I still get similar-ish returns. Because even if we look at the returns of roughly 11.6% over the course of time, we are still going to be pretty close to that 1 million. Now, yes, you could argue with dividends reinvested, you're probably going to push it over the line pretty quickly. But we are still in and around certain areas where we could be looking at this £1 million mark when I'm 50 still. But actually it depends, because you could argue the compounding could become very, very aggressive with the yield on cost side of it, which this may well struggle to simulate. By the way, I always get questions in the comments about what platform is this. This is Snowball Analytics. There's a link below to this. There is going to be, spoiler alert, a Black Friday sale very soon. So jump in, get a free trial account, and then you can apply your code if you want to. There's going to be potentially 40% off, just saying. So yeah, big boy update. It's probably going to be a while before I do any more updates. I will be adding more pennies into this in the next couple of weeks. But yeah, the stability side of it is the main thing at the minute. Obviously, with everything, correcting essentially, this is going to help massively. Don't forget, check out TradingView. Amazing platform for everything, realistically. I will be using it more and more. But if you've not yet done so, watch this video. This will help you with some ETF information around dividends.